Looks like they've all got one. All right. Okay, the approval of the minutes of the September 18th meeting, 2016. The minutes have been moved. All in favor say aye. Opposed, the same. All right, they're approved. First item on the agenda is a review of recent executive orders. Executive Order number 8-16 relating to Senate Bill 419 issued November 4, 2016. And Secretary Kiss will be presenting us with the details on that.
Thank you, Mr. Chairman. Chairman Hall, Chairman Nelson, thank you for the opportunity to be here on behalf of the Department of Revenue. I have with me, as you probably already can see, Mark Mukow and Mike McCown, and I believe Mike Riley may be here, as some questions may come up regarding our responses to those two executive orders, and they're here and available. But I'm going to try to give a brief kind of 24,000-foot overview of what those executive orders do and what we're trying to accomplish in the administration, and then I'll be glad to try to respond to questions myself, and as I said, they're here to respond to questions also. As those of you that follow this process, certainly those of you on the Finance Committee know, we have now moved into another fiscal year. We're nearing half the completion of that fiscal year. And even into the first 2 or 3 months, we began to see that we may be in the same situation we've been the last few years, which we're going to need some, what I refer to as mid-year medicine or remedy to deal with a 2017 fiscal year hole in the budget. I will start by saying while the anticipated problem is not insignificant, it is not near the significance of the challenges that the administration and this legislature has had to face the last couple of years, certainly last year. Last year it was obvious, going back a year ago now, September, it was obvious the magnitude of the problem, particularly the complete evaporation of a large part of the severance tax, that we needed to move quickly. One of the reasons we didn't move as quickly this year is a couple things. First of all, we are desperately trying to not do significant harm to agencies and departments that we believe have been cut about as far as they can be. One of the other things was we wanted to get a better feel for what we anticipated, perhaps some rebound or recovery. Mark can respond better to that. There are some positive signs. There's probably more negative than positive, but there are some positive signs on the revenue spectrum. And we want to be careful as we move forward. Having said that, what we also were attempting to do is get a good estimate for what we saw as a potential shortfall. The governor's executive order uses what I think the executive order refers to as a mid-range estimate in the $165 million range. So we are trying to use that to fashion a solution so when you come back in January and the governor introduces his last budget and probably also other legislation to close that 2017 gap, we can do it. But if you do the math real quickly as I go through this, you'll see that those solutions which have already been in place by these executive orders do not completely close that gap. But the point I do want to emphasize, we believe we are close enough so that we can present to you responsible solutions, the other part of the puzzle, to closing that gap. And you'll see those from the governor in January. And obviously then it'll be up to this legislature's prerogative as to whether they want to follow those proposals or pursue other proposals or how they want to deal with it. You have the same obligation the executive has, and to some degree a greater obligation, to have a balanced budget. We will again be able, I think, to present to you the rest of our proposals that close the hole and deal with the puzzle in January, but you're going to need to decide at that time how you want to pursue them. Real quickly, let me start with the executive order related to the redirection. As all of you certainly on finance know, Senate Bill 419 gave the executive branch the power to redirect something we did last year, monies which would have by statute passed many years ago flowed to the old workers' comp fund to pay off that liability. I'm pretty far, I don't think I'm pretty far off on these numbers, but I don't have them right in front of me. At the time we were in front of you during the session, with the most recent certification by the independent auditor of that liability was about $91 million, keeping in mind that 10 years ago it was in the billions of dollars, or certainly more than $1 billion. So we had about a $91 million certified shortfall as of June 30th 2 years ago. Now this June 30th, we have a certification, I think it's right at $51 million. So as we indicated to you last year, we are on the glide path to clearing that debt. along with some of the other successes this administration, this legislature has seen. We're not there yet. I think I remember telling you at the time when I was in front of the Finance Committee, as we anticipated that glide path and landing would occur probably in 2 to 3 years. We believe we're still on track for that. But at the time you all passed the legislation, you allowed the governor in this current fiscal year to redirect those monies again. The redirection of all of the monies that the governor has the ability to redirect is about $25.5 million. It's not an exact number because it depends upon the collection of two sources of money. If you recall, it's $11 million in lottery. That number clearly is $5.5 million. It's easy to fix. We know what it's going to be. The other part is the redirection of the surcharges, both self-insured self-insured and regular insureds. That number is roughly about $40 million a year, so we're assuming something in the $20 million range from that. So the redirection ability the governor had is about $25.5 million, or in that range. A couple of months ago, when we saw and anticipated this might be occurring, we had started having the Insurance Commission hold and not deposit that money into the old funds so they would be able to move pretty quickly should the governor decide to execute the order. He did execute the order. That order now will move about $25.5 million by June 30th of next year to the general fund instead of the old fund. In fact, I will tell you, because we had been holding some of it, about $10 million of that has already been moved. So that's the first piece we're proposing with the governor's executive order. Again, these are things, as you know, the governor can do by his own action. There's some other things, obviously, that need legislative approval or action. I'll talk about those in a second. But that piece is done. That's basically what the executive order related to Senate Bill 419 does. The next executive order was the budget cuts or reductions. I'm going to give you some very broad numbers, but again, we can get into some detail if you want to. But those cuts, talking about now the budget cuts for the current fiscal year, are in the range of just about $60 million. And without going through all of them, the lion's share of that comes from DHHR, about $31 million, and a large part of that is Medicaid. Also, as I'm sure you've seen, the governor, similar to what he did last year in his executive order, did the same like amount or kind of cut to public education. If you recall, during the session, the governor last year had made that cut, about $11 million to public education, and he had introduced a bill to permanentize that cut. This legislature, exercising its prerogatives, chose not to pass that bill. But again now, since we're facing a deficit situation, the governor has the right and the prerogative and the constitutional responsibility to have a balanced budget. So he's basically doing the same thing he did last year with the executive order. That cut comes to about $12.8 million, and about $11 million of that, or something in that range, $11.1 million, comes from the school aid formula. So when you total the cuts, again, I won't go through all of them. It's basically a 2% across the board, and then a 1% to public ed. The total of those cuts, DHHR, the Medicaid, I talked about a one-time targeted Medicaid cut of about $25 million, comes to $60 million. So when you add those two pieces together, we basically have applied medicine or remedy of about $85 million, $25 million from the redirection, $60 million from the cuts. So there is still some additional lifting which needs to occur. Those things that we're still looking at, we believe we'll be able to present a solution to you when we, as with the Governor Tomlin is leaving office in January, we will present to you in January. Probably what you can expect is in large part those will be accessing one-time revenues, things we've looked at and discussed, as legislatures looked at and discussed, and also obviously the rainy day fund is something that's in play. But we really would like to minimize the utilization of that, and that's why we're continuing to monitor. But we believe that we've identified enough other resources that we can come pretty close to closing that target of 165 that's mentioned in the executive order. But we don't yet have the specific plan because we are waiting and continuing to monitor. We got at least another 30 days, or maybe less than 30 days, to make that final decision. But you can anticipate when the session starts in January, we will make a proposal that will allow you, should you adopt them, and pass those pieces of legislation that are required to close the fiscal 17 hole. So that kind of in a nutshell is how those two executive orders work. Be glad to answer questions. As I said, I have Mike and Mark here. Mike Riley, I think, may be here if there are questions related specifically to the Workers' Comp Old Fund. One other point I do want to make, I forgot to mention. If you remember last year when I was in front of the committees, I was telling you we were concerned about the discount rate we were using in the old fund and the significance of changing that discount rate in terms of the liability of the old fund. One other thing that we've done, but we still have now dropped that liability from $91 million in a certified form, from $91 million to $51 million, even with the redirections that have occurred. But what we also did is change the discount rate, I think, from 5% to 4.5%. We think that's a responsible action. We think it was irresponsible to keep it at 5%. But that's something that needs to continue to be monitored also, given the basic tenets of what we're earning on those resources. That's the presentation. As I said, others are here to respond to questions, or I can respond to questions.
Are there any questions of Secretary Kiss? Delegate Walters.
Thank you. Thank you, Secretary Kiss. Always a pleasure and always precise and to the point.
Thank you.
You used the term mid-range scenario 165. Are you kind of telling us that it could be as high as 320 or 330?
Well, as you know, we always work with ranges. I know sometimes it's frustrating, but we don't have a perfect crystal ball. The mid-range generally we'll look at best case scenario, worst case scenario, and mid-range. The number you just used, no, I don't think there's any way the worst case scenario would be in the $300 million range. But we are currently using, and I want you to understand that, the mid-range, that's the 165 number, shortfall for fiscal 17.
I noticed when you discussed the unfunded liability of workers' comp, you changed the discount rate. And in pensions, we're using a 7% rate of return. Should we be looking at the discount rate in that?
Well, I'll defer to the actuary there, but one thing obviously keep in mind, which I'm sure you appreciate having dealt with this, is there's a much different portfolio, the old fund, in terms of short-term assets. So that's why we believe it became critically important to look at changing the discount rate for the old fund. That doesn't necessarily mean it needs to be changed for the pension funds. I'll defer to the experts on the pension or the actuaries that the pension board uses.
Thank you very much.
On the discount rate reduction of workers' comp, does that mean that the funding streams that we currently still have in place, the 9% premium? Yeah,
the funding stream, if you want to look at it as gross dollars, is about $50 million a year. Again, it depends on what the extra surcharge is. So, yeah, we still think we're on the same glide path we told you before to get that debt cleared. 2-3 years, maybe sooner.
Okay. Are there questions? All right. Did you just discuss Executive Order 916?
Yeah, I think I hit them both. Executive 916, I think, is the cuts, and Executive 816 is the redirection under 419.
All right. Well, you're next up for the revenue and expenditure update.
All right. I'm going to defer that to Mark.
Okay. You're up.
Mark Mika with Department of Revenue. Just an update on the revenues through the end of November, first 5 months of the fiscal year. We collected $1.53 billion. The estimate was $1.62 billion, so we were short by $91.5 million. We are just slightly ahead of last year's actual collections, but that's with the aid of the tobacco tax increase and the extra $10 million or so that was diverted from the workers' comp program. If absent those enhancements plus some that are in the budget, year to date we're running about a 3.6% decrease relative to last year, with a little bit of a decrease in consumer sales tax. The decline rate there is about 1.3% when adjusted out. A decline rate of about 2.5% in personal income tax collections. A decline rate of nearly 45% in corporate income tax collections. Severance tax is down a little bit, but it's been stable in the last 3 months. We've actually met the estimate for severance for 3 consecutive months, so that's a little change from the past. And with that, unless there's any questions, I'll turn it over to Mike to talk about expenditures.
Well, any questions? Senator Carmichael.
Thank you, Mr. Chairman. Thank you for the presentation and discussion. A couple of things. With regard to the tobacco tax, where do we stand relative to projections based on the tax increase?
The tobacco tax year-to-date through November is actually a little bit ahead of estimate by about $5.5 million. It's nearly, not quite, but nearly double collections that we had prior to the tax increase. Now, if you look at the tax increase, it was more than double, but we were expecting some consumption-related changes to go along with that. The numbers are, you have a lot of volatility at the beginning of a tax increase, so our surplus shot significantly up early on. It's eased back down recently, and I think at the end of the year it'll be less than $5.5 million over by the end of the year.
Okay. One other question. I mean, we're obviously going through the mid-year budget cuts because revenue didn't come in as we originally had projected or thought that it would. I mean, just at a 20,000-foot level that you're looking at, what really has changed from the projections in terms of where did we miss, basically?
Well, it starts with the employment numbers. We were projecting a bit of an increase of about not quite 1%, but a little less than 1% employment through the fiscal year. And so far, employment numbers are fairly flat. In fact, when the 16 numbers come in, they'll probably be a little bit lower than statistically a little lower than 15. Although in recent months, we have seen a little bit of a positive employment number compared to last year. I always like to compare with last year. But the positives have been pretty small. 200 job increase in the latest report this year compared to last year in terms of non-farm payroll. The other positive is that labor force participation seems to be rising a little bit. So we have a few more folks, but it hasn't shown up on the withholding tax side. Withholding taxes fell by about 1% in the first quarter, 0.6% in the second quarter. The personal income and wage and salary income was supposed to grow by close to 3%. It's zero. It's flat. So we don't have any momentum there, and that's also swung over to the sales tax. There's some revenue timing things on the sales tax in terms of the municipal tax payments, which shot up for one quarter, as well as an unexpectedly large transfer to the Division of Highways, higher than was projected. If you take those increased transfers out, and we were down about 3% without the transfers. With the transfers adjusted out, there's still a decline, but it's about 1.9%, a little less on that. But it follows the income tax. Corporate tax across the country is way down. The U.S. Treasury is reporting significantly lower corporate payments. So that's a national trend. It's more acute here because the energy sector and related sectors that supply goods to the energy sector, certainly the prices have hit. There's lack of profits there. The value of the U.S. dollar keeps going in the wrong direction if you're interested in foreign trade. So if our foreign trade numbers continue to lag behind, not only for the non-manufacturing goods, but also for the manufacturing side. So that's been a bit of a negative as well. Finally, on the energy price side, coal is actually doing better. Better is a term of art, I guess, but it's stabilized a little bit in coal. Natural gas, we're still down about 50% from even last year. Our pricing in natural gas here in the West Virginia area is significantly, at least for the first part of this fiscal year, has been significantly below national averages because of an infrastructure problem. Now, there's a little bit of good news, at least a hint of good news, in the last month or so. Dominion South prices were averaging only about 1/3 of the national average, and Dominion South is a key price around here. In the last month or so, Dominion South prices have caught up and are lagging the national average by a much smaller margin. So maybe there's a little bit of an infrastructure improvement there that's going to help us down the road on the natural gas side. But natural gas is still weighing us down.
Okay. Well, thank you, and no further questions, Mr. Chairman.
All right, thank you for your questions. Are there other questions of our presenter? I believe now we're going to hear from the expenditure side. You've heard the revenue side, the money we've taken in. Now we're going to talk about the money going out. Mike McCown.
Mike McCown from the State Budget Office. Just quickly, when we're down through the first 5 months, $91.5 million in collections, it tends to stress the expenditure side of the equation. Our cash flow currently is good. We're paying bills. The one major adjustment that we had to make a few months ago is our Medicaid payments. Those are still on schedule to be made the way they were. But before the fiscal year started, if you remember the FY17 budget bill, we had balanced basically the budget with $70 million of rainy day to Medicaid. So we flipped that. We were going to pay that out in January, but since we were running so far behind on general revenue, we flipped some general revenue Medicaid payments to January, and we moved the rainy day transfer up to, I think, August or September. So when you shake all that out, we've moved $54 million of Medicaid payments back a few months in general revenue. That's how we're surviving. We're current on bills. Cash flow is good. Now, if other remedies aren't in place by about the middle of March, cash flow will not be good. But that's something for this next legislature to address. We have about 600, just for your information, $689 million in the rainy day fund today, less a $50 million loan that we just made last week to the unemployment fund. It's a temporary loan for 6 months. So our rainy day is still strong and healthy, over 16% of our general revenue.
Are there any questions of Mike? I believe the chairman of Finance House has some questions. I'd like to have the secretary come back up to answer a couple questions.
Thank you, Mr. Chairman. Sorry to hit you after the fact, but the $30 million from Medicaid, are we just kicking something down the road? Can you speak maybe to any matching federal funds?
Yeah, the $30 million was a DHHR number. I think the Medicaid number is actually 25 million. And no, we're not. I mean, one of the things, as you know, we're doing right now is we're working on the governor's 2018 budget. Our hope is that $25 million cut in Medicaid will be a one-time cut this year and will be restored next year. We're working on that. I don't know if we're there yet. But we recognize the need to do that, and we're certainly working towards that. Now, you say, well, how can they do the one-time cut this year? And obviously, it's not been easy, but I think Secretary Bowling has done an outstanding job of what, as you know, is a several billion-dollar program. So while $25 million sounds like a large number in context, it's not as large, and she believes she can get through this year with that cut. But she is pretty insistent that it needs to be a one-time cut, and we are trying to work with that premise.
Thank you. Without a doubt, we had a tremendous challenge this past session, and looking across the board at across-the-board cuts, when at times I think members of this body maybe wanted to be a little more direct, if we could have. Can you expand upon the discussions you all may have had at the executive branch of looking at specific cuts instead of what I would classify an easy way out and across-the-board cut?
Well, I'm not trying to be critical here, but keep in mind when the legislature finished this budget, you all went the same direction with across-the-board cuts predominantly. It is easier to do it that way, but I don't disagree with you. I mean, the real challenge here is if you're going to solve this problem, which is a structural hole in our budget, you can't do it with across-the-board cuts. As a matter of fact, and I don't think the governor's been shy about this. He's made it clear, and obviously you all can differ, that he believes the across-the-board cutting has gone about as far as it can without creating significant issues, i.e. layoffs, and other inabilities of some agencies or departments to provide resources. In fact, we can get you the detail if you want to dig down to it, but some of these across-the-board cuts were basically modified because we felt in some instances agencies simply couldn't do it. So the bottom line number we expected to see from that agency or from that department, but some agencies may actually have had a lesser cut. But the point you make is well taken, but the other point I would make is, as you know, some of those cuts, whether if you're going to do targeted cuts, require statutory changes. A good example, again, being the school aid formula. We believe, as much as we didn't want to do it, that it was necessary to look at the school aid formula in terms of some cuts or reductions. That can't be done without a statutory change, which only this legislature can do. And some of the other structural cuts, redefining the mission of agencies or departments, do require, and just some examples here would be in some areas, some of the cuts have been discussed in higher ed, require statutory changes. So the governor can't do that by himself. It's something that requires statutory changes. But certainly, across-the-board cutting to solve the 2018-2019 problems that are on the horizon, if your question is you believe that's not the way to go, I don't think the governor disagrees with you. I think he believes he's across-the-board cut about as much as you can. One of the reasons we deferred this decision later than the decision we made last year to cut was because we really didn't want to do that. But we ultimately came to the conclusion that we couldn't get a 17 balance without some additional cuts. And that's how we came up with the mix we did at 2%, trying to minimize it, 1% to public ed, and a large part of that being a one-time cut to Medicaid.
Can you speak to our 6-year plan at this stage?
I mean, the only thing I can do is generally, because keep in mind, I think I swapped messages with you last week. Right now, Mark is in the process of doing what we only do on an annual cycle, which is coming up with a revenue estimate for 2018. That work is not yet completed, so it's very difficult to speak with preciseness about the 6-year plan. But as you also know, you're only 30 days away from seeing the next 6-year plan, and we also generally do not publish a 6-year plan except for once a year. You will see that within the next 30 days, but generally I can say, and obviously we've tried to say this both last year and publicly in recent times, there is a large structural hole. I'm very reluctant to commit to what that hole is right now in the 6-year plan, but not only is there a large structural hole, but unlike past situations that I'm familiar with having been here, it is a large structural hole that proceeds to the end of and beyond the 6-year horizon. And we've had this discussion many times before. There's 2 ways to close a structural hole. You can't do it by using one-time money. It's not certainly in the long term. Cuts or revenue measures. And obviously that's something there's been some differences of opinion between the current administration and legislature, but there is a large structural hole. Now, the other thing I would tell you quickly, again, I know this is something that both the chairs are cognizant of, there are things in that plan, because we basically try to put everything in there we really think needs to be done, expenditure side, that maybe you don't do or don't have to do. But some of those items are also difficult political decisions. There's been a couple budgets now with no pay increases, no across-the-board pay increases. If you take the across-the-board pay increases out of the 6-year plan and decide you just can't do those, that's in the $50 million range. Additional money for PEIA is a significant number if there's not going to be additional number for PEIA. So while we might have embedded in the current 6-year plan anticipated expenditures, those anticipated expenditures may be things that are going to fall by the wayside. But the 6-year plan, as we sit here today, is not pretty. And it is unique in the context that it shows a structural hole continuing for the duration of the 6-year plan, significant structural hole, and beyond that 6 years. So what we're really kind of saying there in a simple lay sense is our anticipation of the revenues, assuming we get the revenue estimates right for 2018, and the time frame in which they will come back, will not keep pace with that structural hole. So again, cuts or revenue measures.
But maybe for the benefit of the body, right now as we look at it and assuming no revenue adjustments, rough ballpark for everybody of where our 218 position is right now as we look forward.
And that's
2018.
everything, even those things that I think will probably not wind up getting funded in the 6-year plan?
Yeah, I think
Assuming everything gets funded?
yes.
Again, keep in mind that I don't have the revenue estimate for 18, which also then causes, by trickle effect, Mark to change the revenue estimate beyond that. But I'm not uncomfortable saying north of $400 million.
Thank you.
All right, there you have it. Delegate Butler.
Thank you, Mr. Chairman. Thank you, Secretary Kiss. Just a question about the cuts that the governor has just ordered across the board cuts, and kind of following up on what we've seen in the last couple of years. When the administration orders cuts to the departments, do they follow up and make sure that the cuts are actually being made? Or, as what we have found out in committee, and I've only been on Finance Committee for 2 years, it seems like oftentimes the departments use special revenue funds or others to kind of fill the holes. They continue to spend the same amount of money. It's just they're not getting funded the way that they were. So,
Yeah, I'll defer to Mike, but obviously what the budget office does is identify and process the paperwork, which then permits the auditor to approve expenditures, which actually does a reduction. I mean, that's what's been occurring for the last couple of weeks. But again, keep in mind that's a general revenue reduction that we impose on them. We can obviously track and see whether they were able to expend someplace else, but that also is a function of how the legislature acts, because they can't spend money if you don't appropriate it. I mean, even if they had $400 million in a special revenue account, if they don't have the spending authority there from you, they can't do that. But I'm not suggesting that I disagree that some of that does occur because they have the spending authority, perhaps. But I'll defer to Mike whether he wants to expand on it. But basically, the cuts we're talking about, keep in mind here, are general revenue cuts, because that's where the structural hole in the problem is. And yes, we have a mechanism, that's what the budget office does, to make sure that that savings actually occurs and is recouped at the end of the year and it's not spent. Does that mean they absolutely cannot find some way to maybe move it to a different account? No. But we can monitor and follow that, yes.
well, you can, but I guess the question is, have you been doing that, or do you intend to start doing that?
Well, this is Mike McCown, State Budget Office. As the Secretary said, we do cut the general revenue. Agencies are, held to spending limits on their special revenue accounts. I'm not aware of any agencies at this time who have asked to increase their spending authority in those special revenue accounts to cover these mid-year cuts. We would certainly scrutinize those very harshly and probably would not approve those.
Okay, thank you.
I think just clarification there, the spending authority was cut. They could have the cash, but they don't have the authority to spend it. So that's what happens in the cuts. All right. Are there any other questions of the Revenue Secretary or any of these presenters before we go on to, I think we're going to go on to talking about the pension plan update from Executive Director Fleck. So we'll go on to that. I believe there's a handout. And you all have handouts. So.
Yes, there should be a handout that looks like this. I'm Jeff Fleck. I'm director of the CPRB. I'd like to begin just by giving you a quick review of who we are and what we do. The CPRB was established by statute, Section 510D in 1991, by the legislature. Prior to that, there were separate boards. There was a Public Employees Retirement Board, Teachers Retirement Board, State Police. The creation of the CPRB put that all under one roof, under one administration. And we now administer 9 unique and distinct retirement plans. Our 2 largest are the Public Employees Retirement System and TERS, Teachers Retirement System. We also have the Teachers Defined Contribution Plan, which was closed in 2005. That's our only defined contribution plan. All the other plans are defined benefit plans. State Trooper Plan A was closed in 1994, and State Trooper Plan B was opened at that time. The Deputy Sheriff's Retirement System We also have the judges' retirement system, EMS retirement system, and our most recent system, which is the Municipal Police and Fire Plan, which we began in 2010. So those are the 9 plans that the CPRB administers. In those 9 plans, we have 78,000 active members and 61,800 retirees. We also have more than 800 employers that participate in the plans that we administer. As of our most recent actuarial valuation, which was July 1st, 2015, there are approximately $13.9 billion in assets, and those are managed by Craig Slaughter and the Investment Management Board. Our board is made up of, we have a 16-member board. We have 4 ex officio members, which is the governor, the state auditor, state treasurer, the cabinet secretary of administration. We have 4 residents of the state who are not participants in our plans. And then we have 8 members that are participants in the various plans that we administer. So that's who we are. Now, I included in this handout some information that I thought you would find helpful. It's a breakdown of our retirees by county. So you can see in your particular district how many retirees we have by county. Of course, Kanawha is the largest. We have 6,735 retirees in Kanawha County. That's just the retirees and their beneficiary. That doesn't include the household. And so we have 46,005 West Virginians that are receiving retirement benefits. And those are the retirees that are living in state, which we found the majority of our retirees do stay in the state. The next slide actually breaks down their income. So you can see by county the revenue that is put out in retirement payments through the retirement system into the state of West Virginia. For 2016, we've paid out $1.38 billion in retirement payments. That's money that's going back into the economy of West Virginia. Some information that I was asked to share with you, and it's the next 3 slides, and it is the contribution rate. Our actuary, Harry Mandel, who's here with us today and will be available for questions as well, estimates that the contribution rate coming up in on July 1st of 2017 will go up from the current 12% employer contribution rate to 12.5% in the public employees retirement system. And you can see the historical information here. If you go back on what the employer contribution rate has been, it's been as high as 14.5% on 2 occasions, back in 2011 and also in 2013, 14. But since that time, it has gradually come down to where it is its current 12%. As of July 1st of this year, of 2016, the contribution rate went down from 13.5% down to 12% contribution rate. But our actuary estimates that it will go up July 1st of next year to 12.5%. That will become official once our board meets in January. So there's information here on state employers, also non-state employers, which we have over 500 non-state employers. And then you can see on here the employee contribution rate changed as of July 1st, 2015. That was due to Senate Bill 529 that passed that year, which created some pension reform for new hires. Anyone hired for the first time after July 1st, 2015 now contributes a higher rate into the retirement system. Instead of 4.5%, which is what it was prior to that, any new hires now pay 6% into the retirement plan. In the teachers' retirement system, employees have been paying 6% since 1970. As I'm sure you're aware, the teachers' retirement plan closed in 1991, and the defined contribution was opened. The defined contribution was closed in 2005, and the TERS plan was reopened. So we have what are called Plan 1 and Plan 3. Plan 1 is anyone who was in the system prior to 1991. And the employer contribution rate is higher for those people because it includes the unfunded liability that's being paid, in which the legislature put a 40-year amortization plan in place to pay off that unfunded liability. For those employees that have been hired since 2005 in TERS, the contribution rate, the employer contribution rate is 7.5%. I would also direct your attention to another handout that you should have. It's called the State Pension Funding Gap 2014. This is a report that was put out by the Pew Foundation. Even though it's for 2014, it was just released this past August. I shared this information with our board last month, but has some good information in it, and really with changes in the Governmental Accounting and Standards Board regulations, specifically GASB 67 and 68, it's created a lot more transparency into the funding of retirement systems. And if you turn to page 10 in that report, I'm very pleased to report to you that there's good news about West Virginia in this report. And in the second paragraph, it says, West Virginia stands apart as having made the most progress on pension funding, increasing its funded ratio from 40% to 78% from 2003 to 2014. That's for both PERS and TERS combined. West Virginia has averaged payments equal to 95% of the actuarially required contribution or higher for a decade, as have 21 other states, but West Virginia has followed a more aggressive funding policy than many of its peers. And so if you look at page 9 of that report, there's a graph there, actually page 8, there's a graph there that shows West Virginia on the bottom, but for this particular list, being on the bottom is not a bad thing. It's a good thing because it shows the net amortization, and we are the most positive of any of the states on that list. So we've made a lot of progress in our pension plans over the years. Some of you who have been here for many years may remember that back in 1991, the teachers' retirement plan was funded at 9%, the worst in the country. We're currently at 66%, and a lot of that is due to this body and also the hard work of the Investment Management Board. But we've come a long ways, and that concludes my report, and I'd be glad to answer any questions, or if you have any questions for Mr. Mandel.
You know, I think it's important to point out that we are number one in something in the United States.
Yeah, I thought it would be good to do that.
Even though some think we're 50th in everything, we aren't. And this is a great story for those of you who have not been here for a while as to how we move from investing in bonds only to stocks and bonds, formed the Investment Management Board, managed the money very well, and here's what you see. And we're not today talking about a significant problem that other states are because of the actions of the legislature the past 20 years. So I felt like I needed to say that. All right, now, are there any questions? If you pension plans, we have 9 of them. Yes, Delegate Walters.
Thank you, Mr. Chairman. Do we have an idea of approximately how many state employees will actually retire over the next 2 years?
No, but I can get you information on how many are eligible to retire. We don't know for sure how many of those that are eligible actually will, but we can get you information on how many are eligible.
Can you do that, please?
Yes, we can.
Okay. And on average, how many employees retire a year?
I don't have those numbers right in front of me, but I can get that information for you as well.
Thank you very much. I would appreciate that.
Okay.
All right. Are you eligible to retire there as delegate? Okay, I will look at it. Are there other questions? Chairman, I want to call you Vice Chair. Chairman of House Finance has a question.
You can call me anything you want. Thanks, Jeff. Appreciate the report. We all appreciate the report. On page 4, it shows West Virginia, and you already noted that on the page 10 reference, that West Virginia across the board were 78% funded for all of our unfunded pension liabilities. And if one goes down a couple of lines, the national average is 75%. If we look back 5 years or even 10 years, what were the relative numbers for both then?
The information I have in front of me here, I can go back as far as July 1st of 2012. As of July 1st of 2012, the PERS plan was at 77.6% funded. It's now at 86.8%. TERS in 2012 was 53% funded. Now it's 66%.
But as far as our
overall.
relative position nationally, do you have any rough idea where
I don't
how
know.
we compare?
No, I
Okay.
don't.
Well, maybe we can
Yes.
chat on it. But thank you. Thank you, Mr. Chair.
You're welcome. Are there other questions? I don't see any. Thank you very much.
You're welcome.
Let's see what's next. All right, now we're going to hear from Craig Slaughter, West Virginia Investment Management Board. I believe there's a hand.
Good afternoon. I'm Craig Slaughter, the Executive Director of the West Virginia Investment Management Board. I have a presentation, which is what you see on the screen, and you should have a copy in front of you as well. And we'll see if this works. I don't know if it's going to. We'll just work with the page if it doesn't. But briefly, before I get into that, because this has to do with performance, I just want to talk a little bit about who we are, because I think there may be some of you who aren't overly familiar with us. The Investment Management Board was created 20 years ago to depoliticize and professionalize the investment management of states' assets, and especially its long-term assets, and primarily the pension plans. That was a culmination of an 8-year process that started after the investment fiasco of the late 80s, which some of you know are very, very familiar with that. If you're not, that's another story, and I'd be happy to talk about it with you some other time. Again, most of our assets are pension assets, probably about 2/3. We also manage money for the workers' compensation, the insurance plans, and some other wildlife endowment fund. The rainy day fund is part of our portfolio. We run the thing much like a we're essentially a mutual fund. We have a series of investment portfolio or investment options, and then the participant plans that invest with us are just simply investors who buy units of ownership in those various options based on asset allocations that we determine for them, which are, again, based on their time horizons and their cash liquidity needs and so forth. As Jeff indicated, we're an investment arm only. We manage the assets for the defined benefit plan, but we don't have anything to do with the liabilities. We pay attention to the liabilities, but they manage the liabilities. We invest only. That's our bailiwick. With that, I'd turn to the first page, and I'm going to talk a little bit about last fiscal year, and then where we are this current fiscal year and where it's going. Last fiscal year, it was driven by some relatively big issues or big events. The U.S. Federal Reserve, obviously, since 2008 has had an outsized impact on markets, and it continued to do so last year with its talk of a rate increase. It's effectively been pulling back its monetary easing pattern that it embarked on back in 2009, and that was a step in that direction. They quickly, a lot of people were concerned about that, weren't sure if the economy could really support the withdrawing of that easing, and so even though they raised rates, they quickly pulled back and paused, and then we saw rates fall once again. Then on top of that, we had oil. Oil is a big issue. I know everybody here in this room is very familiar with the energy situation, being an energy state. Oil, gas, coal, all those assets were down. Globally, oil is the big issue. Then while the U.S. was pulling back on quantitative easing, we had Europe and Japan who were embarking on a heavy round of quantitative easing, much like the U.S. did in previous years. That did stabilize international markets last year, but it didn't really do much to raise them until we got towards the end. And then, of course, Brexit was a big issue. Probably not so much in its impact on the market in last fiscal year, but as a sign of what might come in the future or has come in this country. So market winners with that. Last year, long-duration bonds in general benefited from, the last half of last year, you saw rates fall. And when rates fall, prices rise. Bonds, the longer your duration of your bond, the better off you are, and long-duration bonds did really well. Real estate also did well. I think both part of the reason bonds, rates dropped so low, and part of the reason real estate was attractive was a demand from foreign investors relative to the options they had. I mean, with quantitative easing in Europe, you saw rates go negative in some countries. If you're an investor in one of those countries, you might really not want to invest in a negative rate bond, and so the U.S. looks very, very attractive even though our rates were low. They're looking for other income opportunities, so real estate looked attractive in the U.S. Additionally, real estate was, there was the crisis in 2008, 2009 was related to real estate, but it was a financial problem. It wasn't so much of there was some overbuilding, but it wasn't overwhelmingly that problem. But and then there was but because of it, there was this long pause, and so the real estate market gradually, as the economy healed and people began to start, the economy started growing. The real estate market is in a good place to grow now. It's maybe getting a little rich now, but it did well last year. Market losers are stocks, especially international, and then also hedge funds. Hedge funds don't like these big swings that happen in the market. At least most hedge funds, they'd rather see normal markets and then deal with the normal volatility. And these big one-way swings that we saw last year weren't good for hedge funds. Now, how did that affect the investment management board? If you turn to page 4, our returns were flat, slightly negative, negative 0.1% for the fiscal year 2016. International stocks, we have a relatively healthy weight to international stocks, so when international stocks didn't do well, that hurt us. We had a short duration position in bonds. We chose to play the long game in bonds, feeling that there was more to risk by a rise in interest rates than there was to gain by a short-term fall in interest rates, so we maintained a short duration and high quality. That hurt us last year. And then we have hedge funds, so we got hit a little bit by hedge funds. If you return to the next page, in fiscal year 2017, this is through October 31st, we're up 3.4%. Pretty much everything that was a problem in 2016 was good for us in 2017. Stocks recovered, they came up, international stocks especially, after hitting bottoms in 2016, improved, especially in emerging markets. That short duration position in bonds paid off for us as interest rates started to rise. And then the hedge funds recovered as they always do. My experience with hedge funds is they may have a bad quarter or something like that hurts them, but they generally, because of they have the access to all the tools in the tool chest that you can use as an investor, they can quickly readjust their portfolios and recover and stabilize things and turn the tables pretty quickly. And that's what happened for our hedge funds anyway. Page 6. So that brings us, that's through October. Obviously in November we had an election, and we are now in what might be a new era. And Trumponomics is the term I used for this. I didn't make it up. I stole it from somebody else, so don't blame me. What it means to me, though, is deglobalization, higher fiscal spending, possibly tax cuts, tax reform. Entitlements he's indicated he's going to protect entitlements, and he's anti-immigration. Anti-immigration is essentially, is quite honestly a little bit of a deglobalization thing too. What does it mean for the economy? It means inflation, probably economic growth, and also a strong dollar. For stocks and bonds, a lot of the assets we invest in, strong growth. If there's economic growth, which I think fiscal spending is probably going to generate some economic growth. I don't see a bull market necessarily, but I see a positive growth in stocks over time. But there may be a bifurcation in that. Large multinationals, because of deglobalization, the reduction in competition, that's probably not good for them. tax cuts and tax reforms probably won't help large multinationals all that much. They generally already have low effective tax rates. And if you have tax reform and get rid of loopholes, they're the ones that actually oftentimes benefit the most from loopholes. So it may not help them all that much. I'm not saying it's going to hurt them, but it may not help them. Smaller companies who don't have quite the same political clout, and those companies that play predominantly in the U.S. markets tend to benefit probably more. Inflation is horrible for bonds, obviously. Rates go up, bonds prices go down. We may well be in what I call a bond bear market for an extended period. If you turn to the next page, you give a longer term view of what things could be like. I came up with this chart because I was reading something about the end of the bond bull market, and this commentator was talking about the last 35 years being a great bond bull market, and I went back and looked at the numbers, and yes, and it's true. We kind of all knew that, but it essentially started in 1981, and if you follow it all the way up to the present, I'm a year short here on 35 years, but it's essentially the same. You can see, I mean, the broad and bond market, using the Barclays aggregate as a proxy for the broad market, returned 8.1%. That's the blue bar on the right. The last 35 years. Not a whole lot worse, only 3% worse than stocks over that same period. Then the previous 35 years to that 1981 to 2016 period was a bond bear market. Starting in 1946, rates were extremely low, inflation was low. We were coming out of the war. You can see the numbers for yourself on the left. Stocks returned 10.3. This is the S&P 500. Returned 10.3% for that period. Long bonds, treasuries or corporates, returned 2 to 2.5. It's a broad market. The broad market indexes that Barclays Broad Market Index doesn't go back that far, so I can't use that number, but this is close enough. You can see that now if you do the math and take a 60-40 traditional, long-term institutional portfolio, 60% stocks, 40% bonds, and you do the math, you can see that it's going to be difficult with that kind of allocation to get much north of 7% return during this period. Given where rates are now, we probably are at the beginnings of a bond bear market. How that transpires, I don't know. We may not see rates rise dramatically. I'd be surprised if they took off particularly. I think we still will see a gradual rise. At some point, we may see a dramatic rise. Who knows? We can't look at. We don't have crystal balls. But anyway, it's a note of caution that it's going to be a tough world from an investment standpoint. We actually have a low allocation to fixed income, partly for this reason. Only 15% at present of our portfolios in fixed income. We've been trying to diversify into other assets that can give us some diversification instead of fixed income, because that's what you use fixed income for, is diversification. So we've invested in real estate and hedge funds for that purpose, and we think that's going to play out to our advantage going forward. We have a healthy allocation in stocks because, as you can see from this, it didn't seem to matter what kind of market you were in. The stocks tended to perform the same, somewhere around 10 to 11%. And so we're going to have a healthy allocation to stocks to take advantage of that. I'd be happy to answer questions.
I thought you were going to go on to all these numbers, but you stopped short.
Excuse me?
Yeah, you had a couple minutes. Okay. It's okay. Are there any questions? If you're unfamiliar, I think in the back, your appendix.
Yes.
Yeah, you have the return numbers on what's actually got 2 and 3 on it for the several plans that you can see up to a 10-year number. if you choose to. And it's good information. We get it in Government Finance Committee. I don't think the broad legislature gets it unless you want it, but you've got it there. So are there any questions?
Yeah, Mr. Chairman, I think this is sent out to all the legislators.
Oh, is it?
Yeah.
I'm sorry.
And if it's not, it's on our website,
Okay.
wbimb.org. It gets published about a month. There's about a month's lag, and it's there. And I encourage you to look at it and call me if you got any questions about how to read it or what it means.
I think green is good and red is bad. All right. All right, thank you very much. And now we'll have a presentation by the public. Oh, I'm sorry. I'm sorry. Our House Finance Chair has a question.
Thank you, Mr. Chair. Thank you for the presentation. And so you mentioned our return last year was a negative 0.1%.
Yes.
Yet I believe our pensions are projected to have an earnings input of 7.5%.
The actuary uses an assumed rate of return of 7.5. That's correct.
So the difference roughly equates to how much of an additional liability that we'll have to fund next fiscal year?
I'm not sure I'm the person competent to answer that question.
Is there
the actuary could probably do that better than me.
just a ballpark of Jeff or Mark? I think it's worthwhile, everybody.
Can you repeat the question, please?
Yes. So we had an investment return of negative 0.1 versus a 7.5, I guess, statutory return that we have built into our pension model.
Right.
Which, in essence, results in extra funds that must be put in to make that up. What is that number, roughly?
As I mentioned in my presentation, we expect the contribution rate to go from 12% to 12.5%. 0.5% of the state contribution represents about $4.5 million. $4.5 million for 0.5%.
So 1% would be $8 million, and then if you had 7 on that, so we're north of $60 million extra that would be required to be put in next year.
Well, currently we're at 12% contribution rate. We're going up 0.5%.
Yeah, I think we're you can't. Okay.
If you need further information, we can get it for you. I can get with our actuary.
All right, well, I think the chair's going to say something. I have one other question for Craig. Statutorily, I guess this body has put limits on maybe what you can invest in, and as far as the type and maybe percentages. That has changed over the years. Are there any restrictions still in place that limit what you can do as far as returns? Or do you care to speak to the limits that statutorily have been put on you?
Actually, virtually all the limitations were taken off a few years ago. There are the only limitations now. I'm not sure if they really create a problem. Let me, if you don't mind, I'd like to think about that and see and really go back and think about it. I mean, if there's anything that really might make a difference.
Well, that'd be fine, especially as we look at this new session, and if there are opportunities to step ahead and continue to improve on our diversification, please do it.
Sure.
Yeah. Thank you. Thank you, Mr. Chair.
I think it should be stated, since the press is here, that though you had the 1% return last year, that the 7.5% is an assumed rate, and in the Pew Foundation presentation that was given to us, it shows across the United States what pension plans assume, and it's 7.5 right in the middle. And if you have one bad year, I think you made 17% the year before, or something of that nature. You a pretty big number, so that you look at the overall long term. If you consistently made 0%, you'd have to make some significant adjustments, but that's not what goes on in the pension world. So I just want to make that clear. All right. Any other questions of the Investment Management Board? Or we'll go on to PEIA, and then I think we'll be done.
Thank you, Chairman. Members of the committee, Ted Cheatham with PEIA. For those of you from seniors and long-term care, you're going to be bored to death. We're talking about the same thing we talked about a couple hours ago. This is the presentation we're going to walk through. It should be in your packet. I'm going to go through the changes that we made that the board approved last week. And then I'm going to focus most of our time, since it's a finance committee, on the 5-year plans. So we're going to talk about those in a little more detail. So I'm going to move through benefit changes rather quickly. If you'll just start on page 3. Page 3 is the local West Virginia fund, is what we call it. This is the non-states, the quasi-government entities we insure. We insure about 600 plus clients in that arena. Anything from cities, counties, municipalities, bus routes, that sort of stuff, we cover them here. I'm going to skip this page unless you want me to talk about it, because this has really nothing to do with the finance plan of the legislature. These funds for the non-states are a completely separate pool. They are rated separately. They are accounted for separately. They are not commingled with state funds. And they have county representation on our board now. Yes, sir.
All right, Delegate Walters.
Thank you. Ted, I just want to go through one section of this.
Absolutely.
You show the PPACA reinsurance contribution declining or in a negative. You show the comparative effective research fee, and these are both federal taxes, if I understand, right?
That's correct.
And you show a negative balance on those. Are you anticipating that if the ACA is being done away with, that they'll go away, or why is that in the negative?
Oh, it's a funny figure. That's really what's coming out of the pot. I mean, they're going down a little bit because membership changes.
Okay.
And in 2018, the year we're talking on, the reinsurance contribution, as you recall, is for the losses in the exchange.
Right.
It goes away, and then PROCORI, the patient-centered outcomes research, goes away in 2020.
Okay.
So they're going away. But our membership's sliding out.
All right, thanks.
Mm-hmm. All right, thanks. So I'll skip over this one for now, but what I do want to talk about is the benefit adjustments for the non-states, because this is a similar pattern for actives and retirees. So I'm going to go through a little detail on the non-states. The states will be the same or identical with some slight changes in magnitude. So let's go on through them real quick. Page 4, remember the non-states are not subject to the 80-20 legislation, so they will see a rate increase. And our actuaries have told us it's time to split our plans up to make them a little more actuarially different. So we're going to take Plan B, which is currently 80-20 today, and take it to 80-30. Make a bigger spread between the plans for choice purposes. There is a savings associated with that. And on page 5, you will see that because we're going to lower Plan B, we're going to adjust those premiums down, and we're going to raise Plan A slightly to offset. Item number 4 is a change to deductibles and out-of-pockets. Item 5 is change all medical home copays to $20. Number 6 is to move specialty drugs up to a higher copay, $100 for preferred, $150 for non-preferred. And item number 7 has to do with maximum facility charges. Last year we put in about 20 maximum facility fees, and we're going to increase that number to about 140 beginning of July of next year. These changes for the non-states and states and pre-65 retirees take effect July of 17. These procedures are listed for you on page 6 and 7. They're typically imaging procedures, lab procedures, and scheduled surgical procedures. The way this works is, let's say that you need an MRI of the lower back. PEI is going to set the facility fee that we would charge for that at, make up a number, $600. If you go anywhere in the state of West Virginia, that $600 will cover your cost, and you will not be balance billed. If you leave the state of West Virginia to a bordering county and they charge more than $600, you'll be charged the difference as a non-covered expense. So if you went across the border to, say, Winchester Hospital in the Eastern Panhandle, and Winchester charged $1,000 for that MRI of your lower back, PEI would pay $600. The member would be responsible for the additional $400, not covered. And it's all that subject to the deductibles in the 80-20 or 70-30. So that is our incentive to drive people back into the state of West Virginia in the bordering counties. Page 8 is prescription drugs. We had a couple of options. This is the option that the board approved. This would call for a 90-day mandatory fill on all medications. What that means is if you're taking a long-term maintenance drug, that would be things like cholesterol medication, hypertensive medication, that you're going to be on all your life or some long extended period of time, under this proposal you'd be required to fill it at a 90-day fill for 2 copays. There's a savings associated with it, and I put 3 examples down there about how that may work depending on the drug price. So that's what the benefit changes look like. They're going to be similar through the presentation. That moves me to page 9 to talk about state finances. And I want to walk you down, if you don't mind, of the 2018 column. So if you walk down the 2018 column, you'll see the employer premium and the employee premium at 0. Governor Tomlin did give us guidance for no new additional money for PEIA for FY18. This budget reflects no new revenue. Based on the 80-20 legislation, I cannot change premium rates because we are at 80-20, which means the employer pays 80%, the employee pays 20%. This came up at the session last year, but I want to be clear, very clear, this legislative body and the budget office that you approve for PEIA sets premium rates. The board does not. You set premium rates. If you don't give me any money, I can't change premium. If you give me $100, or you give me $100, I have to charge $20 more to the employees. If you give me more money, they pay more money, 20% of whatever you match. I just wanted you to be clear on that one issue. So with no new money, any changes to keep this plan solvent are now going to go to reductions in benefits. So before I get there, first is the third line is direct state transfer. Last year, as part of the cigarette tax, you gave PEIA $10 million for 5 years to offset future premium increases or benefit reductions. That is the $10 million you gave us reflected in that line. And you'll see it's reflected for those full 5 years. The next 2 lines are benefit reductions, $15 million for medical, $15 million for pharmacy. Now, that's not exact. These are placeholders. I'm saying to you we needed $30 million in benefit cuts, which we have gotten to. In all cases, it may not be exactly 15 and 15. It could be a little less for medical, a little more for pharmacy, or vice versa. It's just there to account for the $30 million in benefit changes we need. We've already talked about the reinsurance and the PCORI fees. Now I want to talk about pay-go transfer. You've always talked about pay-go transfer. What that money is, and today it's about $160 million if you include these active employees and the non-state employees. So if you go back to page 4, you'll see the non-state contribution. This is the current year subsidy paid by active employees to subsidize current year retiree premium. And today that subsidy is about 70%. So the active employees and employers are sending over $160 million to the retirees to subsidize their benefits to the tune of about 70%. And we'll go to that some more when we talk about the retiree plan. It's just the active plan. The other thing we've talked about is reserve requirements. In all the conversations last year at the legislation, we took a hard look this year at reserve and how we were reserving money for PEI and those requirements. The actuaries have lowered our requirement from 15% to 14%, and these numbers are reflected down there what that reserve needs to be. You notice we're going to finish 17 slightly below the actuaries' recommended target. I'm not too concerned about that. We will get back to speed in 18. I could stop here for questions on the active plan if you'd like, or we can do this all at the end because they're kind of tied over.
Delegate Walters.
Yeah, I want to make sure of something here. The additional employer premium, employee premium, the reason you have 0 in there is the governor didn't give you any money. Is that correct?
That's correct.
It wasn't the legislature didn't give you any money. It was the governor didn't give you any.
That's correct.
Thank you.
Yes. Also, if you'll look out, I'd be remiss to not talk about 2020 and 2021. Let's take a brief second to look and explain what's going on here for you. 2019 shows a 7% rate increase, which is, of course, $39 million on the employer and about $10 million on the active employees. That's medical trend, and I've told you last year we're going to look to $50 to $60 million a year in new additional funding to keep the plan solvent. That 7% recommends, the way you should read that line is to say, based on what we're going to do in 2018, if you give us this revenue, we will not have to change any benefits. That's the way you should read that. We need another, on the active side, what is that, $49 million to make the plan whole and keep the benefits with no change but premium increases from 18 to 19. That's what that means. That's an estimate of the money we need additional in 2019. And you notice we need another $60 million in 2020 and another 78 in 2021. Again, every year, 6 to 7%. All right. So with that, I'll go on quickly to the active employees. I'm starting on page 10. You'll notice these pages are identical to what I just talked about. I'm not going to read them to you. If you've got questions, you can ask me, but all the way through, the premium changes, out-of-pocket changes, that sort of stuff. Page 12, same drug changes with the mandatory 90-day fill. That's really the active program. Which will take me to page 13. Page 13 is our non-Medicare retiree program. And again, I got asked the question by somebody in the audience last section. A non-Medicare retiree is a retiree who's less than 65 years of age. So anybody that retires pre-65, typically 55 to 65, falls into this block. We have about 6,000 or 7,000 of them, just so you see the population base. So going down these lines, you'll understand again, the retirees are not subject to 80/20, so they'll see a 4% rate increase. Last year, this $12 million OPEB transfer. Let me briefly talk about OPEB, because we've been talking about liabilities, so I'd be remiss not to. Those of you that are new to the legislature, OPEB stands for Other Post-Employment Benefits. You have retiree pension liability. Everything else that's a retirement liability is OPEB, or Other Post-Employment Benefits, other than retirement. So that's me. That's health insurance and life insurance. Those are the two products we offer subject to OPEB. Life insurance no longer has a liability. We have split that out completely so that now the retirees pay full freight for their life insurance, and it stopped that OPEB liability. We have a $3.5 billion liability for health insurance. To put that in perspective, we have a funding mechanism I'm about to talk about, and it should be fully funded around 2038 to 2040. That is OPEB. So this general revenue OPEB transfer is 4 or 5 years ago, the legislature agreed that when the old workers' comp fund was actuarially sound, that they would then transfer $30 million to PEIA to pre-fund OPEB. That $12 million is the pre-65 retiree share of the $30 million. You'll see the rest of it when I talk about the Medicare retirees. So that is a transfer of the $30 million to fund OPEB. How else is OPEB funded? This is one way, $30 million a year. The second is the trust today, the retiree trust, has over $800 million in it today as its OPEB funding. That earns interest. Typically, not last year, but so last year the trust went down, so we didn't earn any money, but typically we'll earn $30 to $50 million on our trust corpus. All interest revenue from the corpus of the trust is dedicated to OPEB. It is not used for operations under the plan. So that's the two funding sources. It's the $30 million from the old workers' comp fund, as well as interest income on the trust investment. The next line is the general revenue transfer. Again, as part of the tobacco tax, not only did you give $10 million to the actives, you also gave $5 million to the retirees to offset future benefit changes. This is the pre-65 share of that $5 million. And then we're cutting benefits at $2.8 million. That is this one. You can run pretty. You have any questions on pre-65 or? Okay. Move quickly through 14, 15, and 16 because they look the same. It's the benefit changes that we've talked about before. They're kind of identical to the other ones. And come to the Medicare retirees on page 70. Oh, I'm sorry, I didn't see you.
Delegate Walters' fifth and final question.
Thank you very much. Good luck. Don't we have another item that protects it a little bit, and that don't we have a cap on the inflation?
Yeah, okay, great. That's a great
And you
question.
didn't explain that, so would you add that into it, please?
Sure. So let's talk. I'll tell you what, if you don't, can I defer that to the retirees? Sure. Because I do want to show you what's going to happen there that's even more graphic. Okay? Thank you. And if I forget when I get here, I will. So let's go to page 17. And let's run down this chart real quick. It's all identical, right? They're getting a premium increase of 4%. They're not subject to 80/20. You can see the OPEB transfer, part of the $30 million, premium offset of the part of the $5 million, and the benefit reductions. The bottom of the page, you can see the very last line, the 28% that's being paid for by the retiree. Remember I said they're being subsidized around 70%. That's what they're paying. Here goes to the 3%, which is going to come up that Delegate Walters brought up. When we did the OPEB legislation, not in code, it did not show up in code, the Finance Board made a decision to cap the PAYGO money, that $160 million that's moving over there this year, at a growth rate of 3% based on a PMPM set back in 2010, 2011. Okay? We are currently below that cap today. The cap is somewhere today around 200 million, and we're like at 160, so we haven't reached it yet. But understand the cap is going up at 3%, right? Healthcare trend is going up at 6%. There's a delta right there of 3%. And ultimately, that 3% is going to get passed on to the retiree. And if you look across the top, 19, 20, and 21, on the Medicare premium increases, you see them at 28, 27, and 28% because they're going to be picking up a bigger percentage portion based on that 3% cap put in by the Finance Board. And if you look at the bottom chart, the percentage paid by the retiree, you see that's going up. So the subsidy will become less and less. Lots of reasons for this, by the way, too. It's because, the retirees, our retirees are growing. We are growing retirees. We bring in about 3,500 new retirees a year. So the question asked earlier, we lose, unfortunately, we lose about 1,500 to 2,000 a year. So we're a net growth rate of retirees to somewhere 1,000 to 2,000 a year. They're growing. Which also exacerbates the fact that it's set on a PMPM basis and will continue to grow. Now, if you'll go on to the next couple of pages, you'll see the Medicare benefit changes, which I won't read to you. And then on page 21, we have a retiree assistance program I wanted to remind you about for all the retirees that earn less than 250% of the poverty level. It's an income-based assistance program they can apply for. Now, I wanted to mention one more thing for you. If I take the leisure outside of this. Last year, we had quite the challenge, and you all had quite the challenge. And we went into a special session that delayed our open enrollment, and it delayed our open enrollment into July. And we stretched the IRS law about as far as we can because we allowed people to re-enroll and make changes to their Section 125 contribution plan. Because remember, we have had all benefit cuts, and people might have elected to change their contributions. And then we had premium increases, and they might have wanted to stop them. So we allowed them to re-enroll in their Section 125 plan. And technically, we should not have left them make any changes after July 1st, statutory code. We thought about it, we talked about it, we felt like we were still in an original open enrollment. It was just an extension for processing, and that's kind of how we got around it. We cannot do that. We cannot do that this year. The session's delayed a month. We're going to start open enrollment April 1st before you even end the session. If you're going to do something for PEIA, and I'm not asking, I'm just stating, if you are, I would greatly appreciate it if you'd take it up the first day, get it done in 2 weeks, and give it to me so I can plan accordingly. That's all I ask. That's a minor thing. But I did want to bring up the fact that last year we got very close to stepping over the line timing-wise. Take questions.
All right. Thank you all for who've endured to the end. Delegate Espinosa.
Thank you, Mr. Chairman. Mr. Cheatham, back to page 9 for a moment. I'd had a question there, and I think we had skipped on a little further before we opened it up to other questions. Just want to make sure I'm understanding what these numbers represent, 2019, 2020, and 2021, the 7% and 9% and 9% increases. Now, do those figures not assume that the fairly significant benefit cuts are implemented?
They do.
Those are based on significantly reduced benefit package. So if the governor does ultimately propose additional funding and this legislature approves that in FY 2018, the 19, 20, and 21 figures would likely increase based on the continuation of the current benefit level. Am I understanding that correct?
So if I understand your question, they probably will not change. It's really a zero-sum game, so to speak. PEIA, let's call it, we have $900 million. Make it $1 billion. I always round up. Make it $1 billion. We're spending $1 billion. Okay, that's what we're spending. And we've got revenue in to spend $1 billion. And that's a fixed sum dollar that's going to go up at a need of 6% a year, or $60 million a year. All we're talking about is how do you want to spend $1 billion? Do you want more revenue or do you want more cuts? But it's a zero-sum game. If you give me more money, I go up to $100 billion, $100 million, and I don't cut benefits. Or I stay at $1 billion revenue and I cut my benefits by $100 million. So as long as, if you give me more money for 2018, all I'm going to do is raise premiums, reduce the benefit reductions, or make the benefits higher. But my expenditures for 18 are going to be exactly the same. It's just a question of it's going to be more or less claims or more or less revenue. So that additional revenue for 19 assumes 18's fixed. We need another 7% in 19 over whatever plan is in 18. Whatever the plan is in 18, we're going to need 7% more in 19.
But the dollar figures would increase based on...
They may slightly, yes, because right. You're right. If we get revenue now, 7% of a higher revenue, yes, sir.
Okay. Thank you, Mr. Chairman.
Other questions? Let me get this straight again. Since we start late and the budget in theory wouldn't pass until the middle of April, and you do your enrollments April 1st, so you would need a solid commitment as to what the revenue from the budget would be before the budget's actually done.
Yes, please.
Okay. So everybody will know. Just wanted to restate that in simple terms. All right. Maybe we'll just do the budget the first. No. We should do the budget a little quicker then. Question?
Thanks, Jim. Is that a motion?
Is that a motion?
Yeah. Question for Mr. Cheatham.
Yes.
Thank you, Mr. Cheatham. Nice to see you again.
Good to see you, sir.
So, Mr. Cheatham, have you had any indication from this administration or future administrations that you will actually see any additional dollars in the budgets, over the 5-year plan for 19, 20, and 21?
I do not.
So that's just pure theory.
Yeah, just, again, that placeholder number of 7% is
So-
to say to you, if we just took cash in to keep it solvent, that's the amount of cash we need.
So without that, without those dollars, that would be an equivalent level of benefit cut in those out years.
Exactly.
Thank you. Thank you, Mr. Chairman.
I think Delegate Moy, you're kind of hidden back there. See your hand now. Thank you.
Thank you, Mr. Chairman, and thank you, Mr. Cheatham, for coming and presenting again. On page 17, very bottom line, the percent paid by the retiree, and it goes up from 28.4 to 42.3%. I know that that can vary, but what kind of dollars are we looking at? And I know each plan is going to be different, but do you have some kind of average?
Yeah, that dollar amount's on the top line there, Delegate. It's $15.5 million is what that represents.
I mean per retiree.
Per retiree?
Yes.
Oh, I'm sorry. I don't have that. I can get that for you, but I don't have that.
You couldn't venture just some kind of estimate on it?
Sure. Well, let's, somebody's faster than I am. $15 million, just divide that by, we've got 28,000 Medicare retirees. Divide 15 million by 28. Do that real quick. Divided by 12. That's about, according to, unless I did it wrong, about $5 a month.
5.
If I did it right.
Okay.
Again, understand, please, retirees are based on years of service. The highly subsidized are at 25 years of service. They might see the $4 to $5. People in the lower tiers are going to see a much bigger number.
Okay. I know that there'll be a variable there. I just want some idea. Thank you.
Mm-hmm.
All right. Are there other inquiries, questions? Well, thank you very much. We've covered a lot here. You know, the pension system and the OPEB liability and our revenue shortfalls are the biggies. So you've heard about all of them today. Is there any other business to come before the motion is that we adjourn? All in favor say aye. Opposed? We're done.